Peter Eliades with you, Stock Market Cycles update for Tuesday, February 25th. Don't you tell me that the stock market is a random walk. Don't you tell me that it's impossible to predict where prices are going. Don't you tell me that fundamentals are the most important thing. Don't you tell me that all we should look at is interest rates, and that will tell you everything about the stock market. So those are a few don't you tell me's. I'm not going to appear cocky and overconfident on this update. That's the biggest mistake you can make in the stock market. And one of the other biggest mistakes is to think, boy, I've got this thing down cold. And boy, do I know which way the market's going to go. And boy, I'll never make another mistake again. Or my software will never be wrong again. I'm not saying anything like that. What I'm telling you is, over the past several months, I think I have demonstrated to you that the software that you have watched me introduce you to has been bordering on spectacular. Certainly very, very effective in terms of calling market turns. So that much having been said, I had a very good friend of mine today say, you're not taking enough credit for these market calls. You really should be bragging and standing up and screaming and telling people how right the projections have been. I'm not going to do that. That has not been the way I've operated throughout my whole professional life. I don't intend to begin doing that there. And again, I caution you and myself that pride precedes the fall. So don't ever think that you or I or anyone else has the perfect solution to stock market movement. But with that much having been said, we're going to go through the routine now and show you where the projections say the market is going. Okay, this is a nominal 20-week offset, which means it's 48.4 to 55.2 offsets. When I said a nominal 20-week offset, it's a nominal 20-week projection that is generated by offsets of 48.4 to 55.2 trading days. Those are trading days, and that would be the equivalent of a 10-week offset for a nominal 20-week projection. And as you can see, this is the Dow Jones Industrial Average. Today, a lower nominal 20-week downside projection was confirmed. This is the red area right here, and there's the projection. Rounded off, it's 25,510 to 26,507. This is a closing price projection. So mark that one down. Now, we're going to go through these sequence of things with you. This, again, I don't think is a science yet, but boy, it's as close as you can come to a science in terms of predicting the stock market. So these are the nominal 20-week projections for the Dow Jones Industrial Average. Now, what we like to do is get confirmation from all, I shouldn't say all, from the three important averages indexes I like to look at. That's the DJIA, the S&P 500, and the New York Composite Index. So with that in mind, let's take a look at the New York Composite Index. Okay, here is the same offset, nominal 20-week projection for the New York Composite Index, again, on a closing basis. And so this projection, as you can see, we're a lot closer to meeting this one, a little bit further down, and you meet that projection. On New York, it calls for 12,568, rounded off to 13,069, rounded off. So, but those are both confirmed projections because both of the offset lines have been surpassed. So those are confirmed projections. Now, another cautionary word. That doesn't mean you can't rally all the way back up here and then come down here if you're going to meet that projection. And that's one of the reasons we've cautioned you over the past several weeks, especially the last couple of days, when you get a projection confirmed, that doesn't mean you jump in and try and play that projection, because a lot of things could happen. we could get a significant rally from here, still keep that projection in effect, and then come down here and meet the projection. So the most important aspects of projection theory are when projections are met and no further projections have been given. So this is what we look like on the New York Composite Index. Now, let's look at the S&P. Slightly different story here, isn't it? I mean, it could be a very dramatic projection if it's confirmed, and we're not that far away from confirming it. But as opposed to the New York and the Dow, the DJIA, which have both been confirmed with this offset for nominal 20-week projections, the S&P 500 has not. It didn't require that much more today, and tomorrow it'll require around the same number, which is around the 3120 level. Surpassing that should confirm this downside projection. But look what would happen here. On the S&P, if this downside projection is confirmed, you're talking about a move down to at least 2951, and it could be significantly lower than that. It could be way down on this level down here. So that has not been given yet, and that we like to see everything confirmed by the three indexes, three averages that we look at, and that's not the case here. So the projections aren't quite as comfortable as they could be had they all agreed with each other. All we need is a little bit lower on the S&P to confirm that downside projection. We don't have that yet. That's one thing we'll be looking for. Okay, we backtracked a little bit now, and this is the nominal 5-week projection, 12.1 to 13.8 trading day offsets. And as you can see, this is the Dow Jones Industrial Average. We have broken below the furthest extreme of that offset. That implies, it's another suggestion that the projections we gave on the Dow will be fulfilled. Remember, that's the next longer projections. Actually, it 2 cycles up. This is a nominal 5-week. We're talking about a nominal 20-week, not nominal 10. And that one is the one that calls for 25,510 to 26,507 on a closing basis. The fact that we broke below the lower part of this projection range implies that that projection should be met. It gives us more confidence for that new projection. So this is something to keep an eye on over the next couple of days. So that's kind of a general wrap-up of what we're looking at for projections right now. There's a possibility of significantly lower projections on the Dow Industrials, on the S&P, and on the New York too, depending on what happens over the next couple of days. Look, we've had 2 incredibly large declines. I go crazy when commentators start saying, this is the greatest 2-day point decline in the history of the Dow. Come on, give me a break. We don't look at point declines. They mean absolutely nothing. We look at percentage declines. You're going to compare the 2,000-point drop in the Dow with the Dow at around near 30,000, with a 2,000-point decline in the Dow 30, 40 years ago when it was trading at 1,000? No, you can't do that. So don't even talk that way. Don't compare point declines. They're completely insignificant, okay, historically. Talk about percentage declines. And this doesn't even come close to the nearest 10 or 20 greatest 2-day percentage declines in history. So let's put that one straight, okay? One other comment here. We have one other comment, and that is at the all-time high on Wednesday of last week, the all-time high close, one of the things that disturbed me, although I felt fairly strongly we could be at a top of some significance, was the 10-day trading index, ARMS index. It was registering a reading of 1.10. That's not generally the type of readings we see at important market tops or even short to intermediate term market tops. But indeed, we've seen the decline that happened from that point, and it's been significant. So now, several days later, 4 trading days later, with the market down, 6, 7, 8% in just a few days, what's the trend? What is the 10-day trading index? Guess what? It's 111. It's virtually at the same level as we were at the all-time high almost a week ago. And that could end up being very bearish. But again, trading index used to be one of my favorite indicators. I can't say that anymore because there have been some inconsistencies in the last several years that don't match up well with prior historical data. So that's where we stand. To call this market exciting is, I think, an understatement. I know it's all attributable to the coronavirus, but I think the coronavirus was around for a few weeks before all this started to happen. And I think a lot of people at that time were predicting that it would spread a lot further and a lot faster than most people said it would. And so, okay, let them call it what they may. What I'm calling it is cycle projections and technical. Remember the trend line? Do you remember that trend line we showed you last week where there was 1, 2, 3 hits, couldn't get above it? That didn't know anything about the coronavirus. Okay, folks. I hope you're enjoying these updates. They're being given away in anticipation of marketing our fabulous stock market projection software. So keep an eye out for that. Hopefully sometime in the next 4 to 6 weeks, we'll have some very specific information to give you. That's it for this afternoon evening. Haven't subscribed yet? Go and subscribe. Please leave comments. Hopefully they'll be favorable. Please leave thumbs up. Hopefully, if you don't like what's going on, you can give a thumbs down. I'd like you to explain it if you're going to do it, but you can do that. And thanks for watching. If you subscribe, ring the bell. That'll tell you all the updates that come. This has been very wearing for us because it's such an exciting time. The cycle projections and the technicals call this virtually perfectly. And anyway, it is what it is. Famous last words. Thank you for watching.